Alrighty, so this is the ninth video of the Maybe series and the 17th under accounting. And in this video, we're going to be talking about deferred revenue, right? So deferred revenue, just based on what the name says, right? What does this sound like? Well, it sounds like we're going to get revenue, sorry, we're going to get revenue at some point in the future, right? That's what deferred revenue sounds like, right? And essentially, it just is that exactly, right? So, one example of this would be, let's say that you're thinking of a new software product, right? And you decide that, hey, I am going to launch the software product on, let's say, January 31st, right? But it has a specific capacity, right? I can't have a million users on this product. I can only have 100,000, right? So what I do is essentially I say that I'm going to have a pre-sale for essentially buying the software, right? So on January 1st, everyone has to give me their money, right? So you get money, right? And then I'm going to deliver this product on the 31st, right? And if you guys remember from the inventory example or a couple of the other videos that we have, we said on the income statement, we do not recognize revenue when we get cash, right? Revenue or expenses, right? Expenses. We do recognize revenue slash expenses when delivery has occurred. I don't know how to spell occurred, I guess. Occurred, right? And that's a really, really important distinction when it comes to deferred revenue. Because by this principle, and this is a rule, right? This is a rule. We do not recognize revenue when we get the money. We recognize revenue when we actually make delivery of the product, right? So in this in the instance of deferred revenue, sure, we get some cash at this point in time, right? We get cash at this point in time, but no revenue, right? Once we deliver it, that's when we recognize revenue. And that's kind of the thought process around deferred revenue, right? So let's do an example here. And this is going to be I believe the first video under accounting where we're going to have essentially like a two-part question when it comes to some of these accounting questions. So let's look at this example, right? So let's say we get $100 worth of cash as a prepayment, and we are going to deliver the services later, right? So let's look at kind of the step one in terms of what happens to our income statement, our balance sheet, and our cash flow statement, right? Like I've been emphasizing, in terms of our income statement, we just got the cash. We haven't delivered the services yet, right? So nothing is going to be recognized on our income statement. This is blank, right? Now on our cash flow statement, did we get cash on hand? Yeah, we got cash on hand, right? So our deferred revenue account, we are going to get cash on hand for it, right? So our change in cash is going to be a positive 100. That flows through directly to our balance sheet, so we're going to have 100 more. It's under assets, right? And now think about it, right? We have this cash on hand, but we have the obligation to deliver services in the future, right? We have to deliver these services at a later time. And that's the key thing about deferred revenue. Deferred revenue is a liability because it is a future obligation to pay something, right? So deferred revenue falls under, or not to pay something, but to deliver something, right? So it is a liability. And that also makes sense in terms of our cash flow statement, right? So our deferred revenue goes up by 100. Because think about it, our liabilities, an increase in our liabilities is a source of funds, right? Remember the thing, if liabilities go up, that means your cash goes up. So if our cash goes up, that means it's tied to a liability account or it's tied to a shareholder's equity account, right? Because these are the ones that are positively correlated with it. Our assets, if they go up, that's a use of cash, right? Like if we buy inventory, which is an asset, that's a use of cash, meaning that our cash is going to go down. So in this example, we can obviously see that we get cash on hand, right? That's kind of the premise of the question. So just by the nature of this rule, right, we know that this has to be a liability or shareholders equity account. Then we can think about it, well, yeah, it sounds like it's a liability, right? It's a future obligation. Now, I think that's a little bit less intuitive, but I do want to point that out. But I think the most intuitive way to think about it is that you have the obligation to deliver these services at a later time, which means that this has to be a liability. So at this point in time, let's check our equation here. So our assets equals our liabilities plus our shareholders' equity. Had an increase in assets, we had an increase in liabilities, and the balance sheet balances. We're in good shape, right? So now, let's say that that period of time has passed, right? And now we actually have to deliver the services, right? So let's change this. Oops, my eraser didn't stay on long enough. So we have to deliver the services now, right? I guess we are going to forget about all that. But we get $100 cash as a prepayment, and then we deliver the services now. So we have this deferred revenue account. Well, now how are we going to adjust the balance sheet, right? So we already talked through what step one looks like. All we're going to do is have more cash, create a liability, but now we are actually recognizing this revenue because we're delivering these services. So now we're going to recognize it on our income statement, right? And it is simply a revenue account. So we're going to increase this by 100, right? Another thing that I will point out, and I think it's actually good to walk through it, is whenever we're delivering a service, right, we have revenue here, right? So there has to be some cost of goods sold associated with that product, right? It's not like it's just going to hit pure $100 worth of revenue. So let's just assume that there's $50 worth of cost of goods sold associated with it, right? That's going to give us our gross profit of 50. Let's just assume that there's no operating expenses, but we could assume that too. At the end of the day, it's just arithmetic, right? We get our EBIT, that's 50. Then we subtract out our interest and other items. Let's assume that's 0. So we get our earnings before taxes. That gives us 50. Now we're going to calculate our taxes, assuming let's make it simple for ourselves, a 20% tax rate, right? So let's say our taxes are $10 here, meaning that our net income is 40, right? But how are we going to adjust at this point in time, right? Well, now we have the previous items that we have here on our balance sheet, cash flow statement, right? And now we essentially flow through the income statement like we never even did these before, right? So what we do is we start off, our net income is up by 40, right? But now we have recognized this $100 worth of deferred revenue. So now it is no longer a future obligation for us, right? So this plus 100 that we have, we just subtract out this 100, right? So overall, how did our cash change? Let's erase this number as well. All that happened is that our cash is up by 40, just like we had revenue of 50 and we had a tax rate of 20%, right? So our cash is up by 40. Now our deferred revenue account, which is a liability, that no longer exists, right? So you cross that out, right? And we get 0 here. And then we have our shareholders' equity, and that flows through from here. Okay? So that's a positive 40. I wish I did this in yellow so it'd be clear, but just imagine that it is. But that's essentially what it looks like, right? What we did first is that we just adjusted the cash flow statement for the $100 worth of deferred revenue. We adjusted our cash with that and we created a liability with that, right? That's all we did at that point in time. But then we actually delivered the services, then what really happened, right? At that point in time, it's just like we made revenue. Like it's just like we generated revenue with that business. So we're going to associate the revenue with it, any arbitrary like COGS number that they might give you in a coffee chat or an interview, right? And then you're going to calculate out what the net income is going to be, right? Then we just flow that through like we always do, right? Right here, right through here. We offset this deferred revenue account. We offset this deferred revenue account. And all that happened is that we have $40 more in cash and $40 more in shareholders' equity, right? So I hope that makes this a little bit clearer. This is relatively common. I wouldn't say it's quite common, right? But at the end of the day, it's a relatively simple concept, and I would say it's kind of the simplest of all of it, the two-step accounting questions, right? So overall, I hope that's helpful and you guys feel comfortable with deferred revenue now. Let's hop into the next one.